The market is crashing! Or is it? You've seen the headlines, but what's really happening here in the Triangle? Today, I'm going beyond the normal stats and taking a deep dive into the real estate market. This will be one of the most informative and helpful market updates you've seen. So stay tuned. Here we go. Hey everyone, I'm Heather Taylor with Tailored Realty Group, and today I'm coming to you from the Beaver Greenway in Apex. One of the best parts about living in southwestern Wake County is our extensive greenway systems. The greenways stretch on for miles, connecting neighborhoods, parks, and downtowns, and this time of year, it's absolutely gorgeous. So, while the headlines might be buzzing about market corrections and possible crashes, let's take a deep breath and take a look at what's really happening in our local real estate market. Now, today, after we review the numbers, I'll share my thoughts on whether we could see a market crash based on 4 key economic factors. Those are unemployment, foreclosures, homeowner equity, and the history of our local market. I'll also discuss the best ways to participate in the current market for both buyers and sellers. Okay, like we always do, let's start with the numbers, specifically median prices by town and by type of home. As always, I've highlighted the single-family resale homes in green, since those are the types of homes most of my clients are looking for. Now, remember, as I always say, real estate's not just local, it's what? That's right, it's hyper-local. Meaning, even within the same town, one neighborhood can be on fire while another is simultaneously cooling off. And with the data I'm about to share, that point is more important than ever, whether you're buying or selling. So schedule a free consultation on my website if you'd like to dig in further with me. Before we talk about the bigger economic picture, let's take a look at the indicators that really shape your real estate game plan. Like we always do, that's going to be months of supply, the number of listings with price reductions, how homes are selling in relation to their list price, and of course, days on market. Now remember, red arrows, whether they're pointing up or down, mean the market is cooling off or trending more towards a buyer's market, while green arrows mean just the opposite. Whether they're pointing up or down, they're indicating a market heating up or trending more towards a seller's market. Now I'm going to save you the suspense this month and throw the whole chart on the screen. What do you notice? That's right, red arrows almost everywhere. Months of supply is up across the boards, price reductions are up, the number of houses selling above list price is down, and the number of houses selling under list price is what? That's right, it's up. Also, days on market, up across every town. Now, there's always going to be some seasonal adjustment, but with all of those red arrows, you might be wondering, are we actually headed for a market crash? So let's get into it. Let's start by defining what we mean by a market crash. A true market crash means a broad and sharp drop in home values, combined with rising defaults, more foreclosures, and a weak labor market where homeowners can no longer make their mortgage payments. Now, some of us remember what a true crash felt like back around 2008 when prices dropped anywhere from 12 to 40% nationwide. And yes, I was a realtor back then. But just because the headlines sound familiar does not necessarily mean history is repeating itself. So we're going to take a look at 4 key factors that will help us decide whether today's market is truly heading for a crash or not. Key factor number 1 is unemployment. Now, for the Raleigh-Cary metro area, the unemployment rate currently sits below 4%. That's compared to national averages around 4.2 to 4.3%. To put those numbers in context for you, most economists consider 4 to 5% unemployment to be healthy. That's what's known as full employment. Below that, you start risking labor shortages and inflation, and above that signals a weakening economy. So the fact that our local unemployment rate is under 4% shows just how strong our labor market still is. That is a big stabilizing factor for housing. It keeps homeowners working and paying their mortgages. Now compare that with 2007 to 2009, when U.S. unemployment was rising sharply. It got all the way up to 10%. It triggered massive foreclosures. People were no longer employed. They could not pay their mortgage. And we are nowhere near those numbers today. But it does bring me to key item number 2, and that is foreclosures. One of the most obvious warning signs of a market crash is the surge in foreclosures. When homeowners can't pay their mortgage, they lose their home, inventory floods the market, and prices tank. Now, you may have been seeing headlines saying foreclosures are up dramatically, but remember, that's compared to pandemic lows when forbearance programs were in place, home prices were soaring, and almost anyone could sell before facing a foreclosure. If you look at this chart on the screen, you'll see current foreclosure rates are still below pre-pandemic levels, and far below what we saw during the Great Recession in 2007 to 2009. Here in the Raleigh-Cary area, filings are up from record lows, but still lower than the pre-pandemic levels of 2019. So the massive wave of distressed inventory that helped trigger the crash back in 2007 to 2009 simply doesn't exist today, which brings me to our third key factor, homeowner equity. During the 2007 to 2009 crash, many homeowners were underwater or over-leveraged, meaning they owed more on their mortgage than their home was worth. If you were around then, like I was, you might remember some of the insane lending practices that existed, including mortgages that had increasing principal balances month over month. So when prices dropped, homeowners were underwater and many had no way out but foreclosure. Fast forward to today, and nearly half of mortgage residences are what is considered equity rich, meaning their outstanding loan balance is less than half of the home's value. Additionally, the average homeowner in the United States is sitting on roughly $300,000 in equity. That means homeowners today are far better positioned than they were during the crash. Most have substantial equity, and very few are at risk of being forced to sell because of negative equity or job loss. It's one of the biggest reasons the housing market in 2025 is structurally stronger than it was in 2008, which brings me to my final key factor, the resilience of our local market here in southwestern Wake County. When home prices absolutely crashed nationwide between 2007 and 2009, the Raleigh-Cary area saw less of a decline in prices and then actually saw prices rise about 3% in 2008. So while the national market was collapsing, Raleigh proved to be one of the most stable housing markets in the country. So, where does all of this leave us? Given everything I've just told you, the risk of a large-scale crash like we saw 2007 to 2009 appears to be low under the current conditions. Now, I believe we're in a market where correction risk, meaning some downward adjustment, is real, but a full-scale crash driven by mass foreclosures and job loss is unlikely at the present. But low risk does not mean no risk. So some caution flags do remain. Interest rates remain elevated, meaning higher mortgage payments, especially for those new buyers. We have many buyers who purchased at the peak of the market back during COVID, and they're a little bit more vulnerable if values do dip, but generally they're not over leveraged like they were in 2007 to 2009. And finally, a shock event like a global pandemic could change sentiment and cause sharper adjustments. So here are some practical takeaways for you. For my sellers out there, you cannot control the market, so focus on the things you can control. Make sure to prepare and price your house properly so your listing can shine above the competition. I've heard people say recently, the only homes that are selling are either diamonds or deals. So make sure your house is one of the diamonds. Also, your home will likely stay on the market a little bit longer than it has in the past, so plan accordingly. Now, for my buyers, don't rely on rapid price appreciation. Make sure you're comfortable with your payment at today's rates and plan to stay in your house for at least 5 years. For everyone else who just wants to keep an eye on the real estate market, pay attention to those economic indicators like upticks in local unemployment rates or foreclosures, forced selling, losing your job, having to sell your house, having your house be underwater, creating foreclosures. These are the things that cause enough stress on the market that it could create a crash. Again, right now we're not seeing anything like that, but keep an eye on those things as we move forward. All right, that wraps up my October market update. If you'd like to share your thoughts, and I know you want to, drop them in the comments below. If you'd like to chat with me about anything that we covered today or anything related to the local real estate market, book a free consultation on my website. I'd love to chat with you. If you're enjoying the content, please like and subscribe. Otherwise, I will catch you next week. Bye.